In fact, it was the equivalent of about a $300 billion a year tax on US households. I like to look at a chart that I call the world's oil bill. This is the value of all the oil in the world divided by world GDP. And historically, this has run about 2 to 3% of world GDP. When it gets to 5%, we always have a recession. And so in 1974, 1975, it got to 5%, we had a global recession. When it gets to 7%, we have a very serious global recession. In 1982, it got to 7%, very major world recession. Well, in 2008, the world's oil bill was 7%. So we were very much moving into recession even before the financial crisis hit. In fact, Lehman collapse took place in September 2008. Bear Stearns took place in like February, March 2008. The US recession actually started in January 2008, and it was largely caused by recession, by these high oil prices. Basically, the weakness in the macroeconomy from high oil prices spilled into the housing market, and the weakness from the housing market spilled into the macroeconomy, and these two forces reinforced each other and led to a massive housing bubble and very weak real disposable income. Housing took the brunt of the hit. It was primed for a decline. Between 2000 and 2007, the share of all US household wealth held in housing had increased by 8 percentage points, which was basically almost an unprecedented increase in the value of housing. So we were primed for a fall. Now, let's just think through the different actors in this process and think about what the incentives were for each of the players. Let's talk about regular households first that owned houses. They were seeing the value of their houses increase sharply. They were feeling wealthier. They were able to go to the bank and go to financial institutions and get home equity loans, and they were basically able to use their houses as ATM machines. Alan Greenspan, just before he left the Fed, did a research paper where he measured what he called mortgage equity withdrawal. This is the extraction of wealth out of one's house. He estimated that in the years 2005, 2006, 2007, Americans were extracting between $600 and $800 billion a year out of their houses, and were putting this toward consumption. He estimated that Americans were boosting their consumption 4% because of the money they were pulling out of their houses. Clearly, this allowed Americans to consume beyond their means, and this set us up for a fall. Anyway, if you owned a house, you were doing pretty well in 2005, 2006, 2007. Now let's put ourselves in the shoes of the speculators and the investors. Basically, they were seeing 30% appreciation on houses. This meant that you could make a good profit even if you only bought a house and owned it for 3 months, 6 months, or 9 months. Let me give you a very interesting statistic. Traditionally, about 3% of all houses in America are bought by speculators. If you look at what was going on in Miami, in Las Vegas, in San Diego, in Phoenix, in some of these markets in 2006, 2007, up to 50% of houses were being bought by speculators. Clearly, we had a bubble that was in the making. Now let's put ourselves in the shoes of the credit rating companies. Credit rating business is paid for by volume. The more deals you do, the more deals you evaluate, the more revenue you make. They had an incentive to keep promoting deals and to make more profits. And now let's put ourselves in the shoes of the investment banks and those who are doing the securitization. Again, they were doing the financial engineering. They were collecting the fees on their underwriting. The more deals they did, the more profits. So they had an incentive to do this also. Just to be clear what we're talking about, what some of this deal making was, some of these investment banks were taking a pool of, let's say, double B plus rated mortgages, and they were slicing and dicing these mortgages, making some piece that would be double A, another piece double A minus, and another piece that would be called toxic waste. The investment banks knew that this was toxic waste, but they thought that they would deal with this problem later. In fact, the profits were so high from making the double A portion or the double A minus portion that they actually were considered, the toxic waste portion was considered worth keeping just because you were making so much money on the rest of the deal. Well, as long as housing prices kept appreciating, and as long as foreclosure rates remained low, every player in this system had an incentive for it to keep going on the way it was, to keep doing what they were doing. There were strong benefits to the economy. Construction was booming. Employment was strong. The politicians loved it because it was good for voters. It made voters happy to have strong home ownership. The problem was that by 2006, the U.S. housing market was completely saturated. We'd built so many houses that everyone, and credit had been so cheap, that everyone in America who wanted a house had one already. And because of this saturation, the investment banks and the others that were generating these, who were in the mortgage business, started a race to the bottom. They started to reduce their credit quality standards in order to keep trying to keep their volumes up so they could keep making the profits. Now, meanwhile, the booming economy was starting to raise inflation fears, and the Fed had to start raising interest rates. And so this was when the Fed funds rate was going from 1% up to 5.25%. One other factor was that many people had taken adjustable rate mortgages in 2004, 2005, 2006. And these adjustable rate mortgages were resetting. When they were resetting, the average household was seeing an increase of about $500 a month in their mortgage payment. Some of these people started to fall behind on their payments, and we started to see an increase in defaults. Now, why did this problem spread from the subprime sector to the whole economy? That's a very interesting question. Housing by itself is about 5% of the US economy. In a normal recession, it falls in half, roughly, and it did fall in half. So it takes away about 2.5% of GDP, and that is exactly what happened in 2007, for example. This by itself is not enough to cause a recession. We basically dropped growth from about 3.5% to about, say, 1%, 1.5%. The economy could have withstood that by itself. The problem was the high oil prices were also knocking a couple of percent off GDP, and that basically put the economy into a very serious recession. What happened then was housing prices started to decline. As housing prices started to decline, suddenly all these people that had 100% loan-to-value mortgages were what we call underwater. They owed more on their house than their house was worth. By early 2008, 10% of all US households were underwater. And of course, this tended to undermine confidence and undermine consumption. We started to see housing, durable good purchases decline. People weren't buying furniture, appliances for their houses. They weren't buying automobiles. And so the whole thing started to unwind. Basically, we had this very weak economy that was already in recession when Lehman took place. Lehman was the pinprick. It was the pinprick that burst the bubble. And this basically began a very vicious cycle of unwinding and deleveraging that spilled over the economy. We're now seeing a very logical outcome from these events. Americans had a saving rate, historically, Americans have a saving rate of 7%. Well, the saving rate got to 0 and actually was negative in 2006, 2007. We're now seeing that saving rate being rebuilt. This is the plus side of the recession. We're already up to a 5.7% saving rate in April, and so we are basically getting back to normal in terms of rebuilding our savings. But this has really knocked consumption, and we've had extremely weak consumer spending the past year.